I think we're good to go.
Good to go.
Okay, yeah. So everyone who, those who don't know, this is Rachel Winston. She's the head of our customer service area, our director, and of course, Paul Farella, managing director, and of course, me, Alexandra, CEO.
Yeah, right.
Okay, so let's do the disclosures first, if you would, Rachel.
Absolutely. Let's get started.
Okay, our disclaimers.
Yes. So I'll go through this quickly and then have a quick comment before turning it back over to Paul and Alexandra. So our disclaimers here, this presentation is not investment advice. This is not an offer to buy or sell securities. The information contained is believed to come from reliable sources, but we can make no guarantee of its accuracy. And we have a link included below, investwithwillow.com/disclaimer. Where you can review all of our disclaimers, keep them for your reference and records. You can also view our terms of use and service as well. So we encourage you to take a look. The note I'll make, we do have some prepared comments, some content that Paul and Alexandra have worked quite hard to put together and share with everybody. Of course, we have room for question and answer at the end as always. We always appreciate your questions. So the way to submit a question at the end when we get to that point is at the bottom of your screen, there will be a little chat icon with a Q&A beside it. You can go in, submit your questions that way, and we'll make sure everybody's questions do get addressed. And with that, I'll turn it back over.
All
right.
So I'll just start with the investment case. Like
Well,
why? Or wait, oh, you're gonna want to start?
Yeah.
Go ahead. He's starting. Yeah, do it.
Well, just for those of you who are aware, this is part two
Yes.
to a series we're doing on digital assets and cryptocurrencies. And you can check out part one. I believe it's on our website. If not, you'll get a follow-up email after this with a link to both part one and part two. Part one, we went over some of the general aspects of what a blockchain is, how does a distributed ledger work, why is this technology on our radar, why do we believe it's worth investing in. In this presentation, we're really going over our investment case, the different things we see out there that to us compel us to say, hey, we really need to pay attention to this. There's a lot of development happening in this space. There's a lot of different information out there. So this is sort of how the conclusion that we've come to in our assessment of where we currently are.
Right. I'll flip to the next slide.
All right. Let's go.
Right.
So before we get,
Mhm.
before we get into the weeds here, I just want to say again, and there are some people on this call that are repeats, but we see that there are several who are not. So again, the reason why we started even looking at this class of investments, so to speak, is because the way we look at this is it's the next wave of internet. Let's take the internet on steroids. And that's what we see as the opportunity here. And again, it's not about it being a currency. It is about infrastructure. It's about a new infrastructure that's going to bring much more speed to the process. So anyway, so that's the top view. I'll let Paul go into some of the deeper stuff.
Yeah, so we're going to try to touch on most of the subjects listed in this list here, from what creates that investment thesis for us. So the innovation of the technology. As you know, we're an ESG focused firm. All of our traditional investing, we always do through the lens of environmental, social, and governance and sustainability, and how we can really bring that into a portfolio. We'll briefly touch on how digital assets really do blend extremely well with the whole ESG world. There's obviously the case for return potential. A lot of people look at digital assets as a potential hedge against traditional assets. There's also a big macro theme or macro view of generational shift that we'll talk about and get into a bit of what's happening there and why it's compelling for this asset class. And then some of the fundamentals that are happening in the space in terms of adoption and what's happening out there on a corporate level. And then all these different cryptos and tokens and how they're being used more and more and more. There's this whole conversation around store of value, so we wanted to touch on that. And then this idea of information asymmetry, where people have unequal access to information and how that can play out in markets. And then briefly, we'll talk about the current regulatory environment, why we believe it's actually positive, and then go over again some of the risks. So let's jump in.
All right. And I do see we already have a couple questions rolling in. I'm going to, again, make sure we get to everybody's, but we'll table them to the end.
Okay, perfect.
That's right. If you have questions at any time, feel free to add them to the chat.
Mhm.
We'll address that.
Love this.
Right. So Web 3.0, right? That is where the internet and internet infrastructure and everything is moving over the coming decade. It started in the 90s with things like Netscape, where you had dedicated infrastructure or buildings and servers that originally were intranets, where a business would do all of its internet internally,
Yep.
right? And then maybe they would connect to a public thing, but that was all still being built out. Then you moved into the Web 2.0 that really opened up the internet and connected basically the entire world. But this really relied on centralized services that you have to trust and that have control of all your data. We've already seen some of the issues there where there's these massive data hacks where millions of people's social security numbers or whatever get hacked and leaked. But it was very cloud driven, and that was the next step of internet infrastructure and technology. So where that goes from there is this idea of edge computing or decentralized data architecture that allows basically companies all over the world. It just spreads it out, right? So some of the, I always thought this chart, or I found this chart to be pretty interesting because it shows how it started with like the Netscapes and the AOLs and how that eventually transitioned into the social networks like the MySpaces and the Facebooks. And, there's winners and losers in all of these categories. And then that moved to the more like the gig economy type of sites like the Airbnbs and the Ubers, things that started to give ideally or essentially more power to the consumer and the person, more choice. And then it moves into digital currencies and then the infrastructure of distributed ledgers, which takes it all to a whole new level. And why were each of these things adopted previously, like from the Netscape to where the internet is today, is essentially this main theme that we'll always come back to, is that because it made things cheaper,
Yep.
faster, and more secure. And so naturally, that's the direction that business is going to go.
Yeah, and as many of you know who were at the beginning of the internet boom, you can see that the increase in productivity and efficiency that created. And so we think that this next wave is going to just create that much more efficiencies.
Right. And
Yeah.
what's so amazing about that is, and I believe I mentioned this in part one, but when you can do something 1,000 times faster or more efficiently, you don't just do the same tasks. You can now start to do new tasks or new ideas to bring data and use it in different ways that just weren't feasible before. So it opens up this whole new level of innovation. So that's what we're starting to see in this space, and many of these different digital assets that we're attracted to are building that out. Next slide.
You can see clearly from that little slide, for us, it's not about it being a currency, it's about it being a whole new tech revolution, so to speak.
And this slide, I think speaks really
Yeah.
well to that. This is just looking at the Ethereum ecosystem. So this is just one blockchain there's potentially hundreds of them. But this one has, I think, at least a third of all cryptocurrencies are currently on, our digital assets and token projects are currently built on Ethereum. So Ethereum, the blockchain itself, acts as that base layer, that settlement layer, where you have that irrefutable proof that, yes, this transaction happened. And then, as I talked about in part one, on top of that, you can start building things where you're trading data or contracts and different layers of applications that can be built on top of that. And essentially, this is what the Web 3.0 is built upon, this kind of base layer infrastructure of Ethereum. So the whole world of DeFi, if you've heard anything about that, is just decentralized finance. And the reason it's enabled is because of these kind of platforms with the smart contracts and the way that they all interact and are able to then build on top of each other, while not relying on any centralized entity to act as a gatekeeper. So,
Okay, next slide.
So, right, wanted to talk about one of the major use cases of adoption that is happening on many different blockchains, but it's the idea of stable coins. What a stable coin is, it's just saying that it's stable. It holds its value at whatever it's pegged at. So what we're seeing is many different companies are finding ways to do a stable coin that tracks the dollar or that tracks the euro or that tracks a basket of currency. There are some that do specific to gold that are tied with just gold. But the main idea is that instead of having dollars in your wallet, in your pocket, you could have a digital representation of that dollar on a blockchain. And then anybody that's tapped into that, you know, you can interact with it. And this is really taking off because it's faster, more secure, and more efficient than many of our current systems. As of recently, or Q1 this year, $52 billion in stable coins have already been put onto blockchains. So, and you can tell by this graph, it's parabolic.
One of the things, I want to impress here too, is we recognize fully that we liken what we're experiencing somewhat to the Wild West.
Mhm.
It's uncharted territory. And, you can liken it a little bit to the internet boom when it first, or the internet when it first started. You're looking into a black box. But this, what we see happening here is it's a whole new market. It's the Wild West. I mean, that's the best way we could describe it. But this is, you can see that the fury into these things, the amount of money that's flowing in is rising exponentially. And that's a little bit concerning. The slope of the curve is a little steep.
I
But,
bet if we track this logarithmically, which
it would be better.
It
It would be,
10, it would
yeah.
show a nice steady
Yeah.
growth
Yeah.
and adoption. So,
okay.
next slide.
Next one.
Right. So the other major innovation of blockchain and distributed ledgers is that they allow for tokenization. And basically what that means is you could tokenize anything really, and you're giving a digital representation or creating a digital representation of any real world asset. Right. And this is a study that was done by, I believe Deloitte was one of the main researchers involved in this. Again, one of the big four. To us, that shows again how serious this space should be taken when you have the big four auditors really looking at it and doing a bunch of research into it. But even they came to the conclusion that they believe that within the next less than a decade, so 5-6 years, they expect around 24% of global GDP to be actually on a blockchain. So when we talk about infrastructure and like that base layer, businesses are moving to this kind of platform because it makes sense on so many levels, from how much money they can save, from the efficiencies that they can realize adopting this kind of technology, replacing their current dated infrastructure and back end of all these massive server farms and databases and antiquated ledgers with this newer system that is just much more efficient.
It's interesting, tokenization, when Paul said you can essentially tokenize virtually almost anything. So, this could revolutionize certain industries that are not fully recognized, like art. Okay, we were talking about this the other day. You can literally
art and artists' data rights. There's things like, I'm sure you've probably heard of NFTs or non-fungible tokens. That's kind of the buzz right now going around, but it represents an entirely new way for artists or content or creators to really own a piece of and monetize their work, right? And own a piece of it in a way that they just couldn't before. And what's interesting too here is this chart really is only looking at more financial assets or investable assets. And really, when you look at tokenization, it can be literally limitless. So next slide. All right. So big question we get asked about is about the environmental impact of cryptocurrencies as a whole. And this is just looking at Bitcoin, right? Because that's where most of the data is available for. And Bitcoin is it is the largest proof of work consensus mechanism using blockchain out there. Proof of work uses the most energy, right? But according to this study, it was done by Deutsche Bank and Chinese National Energy Agency. Morgan Stanley was a part of it. The EIA. All did this big study on, what is the renewables penetration in crypto mining. And they found actually that it's almost 80%. I mean, 77.6% of Bitcoin's electrical usage is coming from renewable sources. So to us, that's amazing.
I mean,
Yeah.
it really helps the argument around
Right.
this issue, because, you know, obviously environmental impact is something that we are concerned with, but
And,
with
and
this.
I love this quote that came from this study, right? It says, 77.6, making Bitcoin mining more renewables driven than almost every other large scale industry in the world.
Yeah.
So it's pretty fascinating to me. And then to get a little deeper on that, and I've probably, some of you might have heard this before from me, but when you look at where these mines are set up or where people are building crypto mines, they're usually by hydroelectric dams that are, you know, the turbines that spin 24/7, and on off-peak hours, we don't have the battery technology capabilities yet to really store that in an efficient way. So that electricity is essentially wasted. So instead of it being wasted, it goes and gets diverted to power many of these mines. So I always thought that was awesome. And then just to touch again on some of the other environmental things that blockchain can enable from a use case standpoint, right? It can just make tracking and trading carbon credits way more efficient than any system we have out today. And then the level of transparency and line of sight it provides into supply chains, from, you know, the extraction process to the manufacturing process to the distribution process to the cradle to grave. Basically, you have a line of insight and transparency that is just not feasible with current technology. But having this immutable trail, and then using like molecular tracers or something, you could literally follow a copper bar from its extraction to all the way through its life.
So it's manufactured where it actually ends.
Right. And then as an end user and end consumer, you can then start to have the ability to, demand, I want to know that the products I'm buying are from renewable sources or whatever. And you can have that level of transparency to really look in and see, yes, this matches my values and it was done in a sustainable way. So pretty cool stuff that's happening in the environmental world. So next slide. So return potential. So have to preface this with, past performance is no guarantee of any future results. But that said, the annualized rate of return on Bitcoin over its 11-year history is 230%, which is outrageous, right?
Yeah.
But what we're looking at here in this chart really is what's called an adoption curve or an S curve. And you can see where we currently are in that cycle. The yellow line really represents how much of a population is using whatever technology or innovation you're talking about. And then the blue line really shows like who's the innovators, the early adopters, the laggards, and where we are in that process. And when we look at return potential, really, we're still pretty early on in the early stages of this process, which to us makes a compelling case for
just let's be clear, that doesn't mean we think we're early in Bitcoin. We're just early in the infrastructure, those
distributed ledger technology as a whole.
Yeah,
that's what we're talking about.
All right, let's see what we got.
All right. Yes.
Okay.
So there's a lot to talk about around hedging, right? And why this asset class as a whole might make sense for some people. And one of those reasons is to hedge against other uncertainties or things like this chart, right? Where it shows the purchasing power of $1 from 1910 to 2020. And as you can see, the purchasing power of $1,000 from 1910 until today has dropped something like 95%. And why? Because of things like inflation or central bank controlled issuance of money. Where,
too much money.
right, you can keep. So one data point that I thought was worth sharing here is that even at a 2% inflation rate, right, and that's what the Fed's targeting, your purchasing power gets eroded by something like 10% or 20% over 10 years because of that. It's something that most people don't think about, right? And so here, us as people, we all have to rely on our central banks and governments to issue currency and to ultimately be responsible. You could make a case that that might be a foolish thing to do, to trust an entity to be responsible with issuing money. As you can see, there's been how many currency crises over the past 40 years. Just recently, we were just talking about in England,
1992.
1992, right, the pound.
Yeah.
There was a massive currency crisis
Mhm.
there. So established governments, it comes down to trust, right? And based on this chart, do we want to keep trusting? Maybe, but
Next slide.
right. Here's another thing, right? Yeah.
It's more, more looking to continue to hedge
Mhm.
against the US dollar. And we don't think that's necessarily a bad thing to do at this time. When you see the number of, it would made sense that the US dollar was the reserve currency for many, many years because we were the dominating economic engine in the world. Well, that's, you now see China taking over. And if you actually look at the emerging economies, their percentage of, in looking at the emerging economies as a whole, their percentage of GDP is greater than ours. So we argue that at some point, the US dollar may not be the reserve currency. And, as we lose market share, as we lose our percentage of global GDP, that's a good possibility.
Right, and this chart just really illustrates that point where it shows the share of global USD reserves are just on a downward trend. So something we pay attention to. It's a longer term theme, but to hedge against it to us makes sense. Right, so here's another one, right? Negative interest rates. This actually is a little stale, this data. I believe the recent number is closer to $18 trillion are now in negative interest bearing vehicles or bonds.
Negative interest bearing vehicles.
Yeah.
That's just not okay.
Wild. So, right, the normal saver puts their money into a bank and that bank or, into a savings account or something. It goes to buy money market funds. If they're treasuries, it's tied with government yields in the treasuries, right? Yeah. So if you're getting negative from that, is that really where you want to put your money?
And there's a problem with this. Okay, so I just want to say this, that negative interest rates push risk assets, and that is an issue. Let's face it. I mean, that's a big problem because there are people who don't belong in risk assets and are taking that risk. So we are seeing this chart's been, like Paul said, it's the slope of this curve over the last several years has just been going exponentially higher.
Right. And negative interest rates are made possible through having an inflationary currency. And so when you're able to just keep adding supply and keep printing supply, it makes this kind of environment that much more likely to continue to play out.
Yes. Next slide.
Right. So I just wanted to touch on tokenomics. So I was
really do a good job on this one, okay?
Yeah.
Because this one's a little bit.
It's important,
Okay,
right?
yeah.
So when you look back at the last slide, right, this whole idea around inflationary currencies, and that's really what the current system we have and how we trade globally and the dollars we use are basically all based on this inflationary system where the central bank or Federal Reserve, whatever country can print out new supply whenever they feel like it. Arguably, that can have unknown impacts, right, on the market. For now, it doesn't seem to be affecting the US dollar standing too much, but as we pointed out previously too, it does, put some cracks in the foundation of the stability around that whole system. So tokenomics is really looking at the internal economics of a specific blockchain and the digital currencies and assets that operate on top of it. So for example, Bitcoin has a finite supply, right? There is a limited supply of Bitcoin that there will ever be. There's no way to print more. There'll never be more than 21 million of them. So it is essentially deflationary in nature because people will lose Bitcoins over time and there will never be new Bitcoins made. So you have a cap on supply. So that's appealing to a lot of people instead of the idea of a currency that can go to infinity or have infinite supply, right? And then when we look at Ethereum, the second largest blockchain, it also, right now it has an inflationary issuance rate of around 2 to 4% per year. But Ethereum 2.0, which is all in process and rolling out over the next year or two, basically flips the script there and turns it into a deflationary mechanism where actual new issuance can get burned and no longer it's usable. It keeps the supply basically capped. So why do we look at tokenomics? The reason is when you're trying to value some of these projects, you have to understand what gives it value based on its usage and what forces or third parties are holding it up, right? And if and when those conditions change, how does that impact the supply and then the value of that token? So let me think of an example here. Right. So if you have a token like Chainlink is a crypto that we're looking at. If you look at how that works, right? There's a certain supply of it, certain amount of it gets locked up to fund the project. Okay, so that's off the balance sheet or whatever. A certain amount of it gets staked or is what people put up as collateral. And then a certain amount of it is a free float that just gets traded on exchanges. So you use that token to put up as collateral as a user of that network, and then you get paid for it, right? As like a dividend or an interest payment, okay? And so when the supply and demand of that changes, it impacts how much technically the token's worth and how much you should get paid. So that's why we pay attention to these kind of things in this space.
So when you get a new Webster dictionary, you'll see the word tokenomics in there probably.
Most likely.
I like how there's a whole new language being created here.
Yes.
So, all right.
Definitely is.
Yep. Okay.
All right. So this is a fun one.
This is huge.
Right.
This is, what piques my interest, obviously, is, in the work that I've done over the last 34 years, we are trend followers, right? So, trends to us, and especially looking at generational shifts, are huge. And I think we are in one of the largest generational shifts that I've experienced in the 34 years. And there's no question that they were born with those devices in their hands, right? So, the adoption here, I think, is going to be much quicker among this group. But and they are going to be taking over soon, so we need to pay attention. So go ahead, Paul. You want to talk about that?
Yeah, I mean, you touched on most of it. Just the main takeaway here is the macro picture is that this generational shift is happening, basically from the baby boomer generation to millennials. With that, there's a massive wealth transfer that I'll get into in a second. But also, there's a very there's different values and priorities that each generation hold, and how that's going to play out in markets, in investment. To us, it makes sense. It really ties well with blockchains and cryptos. You're also going from I forget the exact word, but a generation that adopted technology and started using it, to a technology or digital native generation that was basically born using technology and with it. So it's very easy for that generation to look at things like, okay, I'm going to, swipe a button on my phone and send money that way. Like, that's natural and that's really easy. But a different generation who didn't grow up with that might be much more skeptical and hesitant to participate. Right.
I find it really interesting in the Gen Y column at the bottom, preference when making financial decisions. I'm surprised by that face-to-face. Do you think that's a misprint?
I'm trying to think where this came from.
I'm just, I'm noticing that,
Right. My personal take is, I think it has a lot to do with more communicating with a friend, or that face-to-face communication of, right, let's talk about this first. And then I have no problem doing it all digitally. That's just me. So I don't know. Yeah.
So, okay, next slide.
Right. So this chart just shows how much wealth is actually transferring over the next decade. And you're looking at 20+ trillion potentially moving from one generation to the next. And where's that 20 trillion going to go? Right. A piece of it will go to pay for the nursing care and all that for an aging demographic, but the vast majority of that will get invested somewhere.
Yeah.
So next slide. Fundamentals. All right, I'm gonna try to go through this in the interest of time a little quickly, although I don't think we're too bad. So what this chart shows is just looking at Bitcoin, but it looks at or how many Bitcoins are currently on exchanges. So places where people can buy and sell and trade. And you can see that the orange line, which is the volume or the amount of Bitcoin actually held at exchanges, has gone down significantly over the past year.
Exchanges like Coinbase and
Coinbase,
Gemini and, you know,
Binance,
Binance, the, just like, you know, a broker dealer like TD Ameritrade and so on.
Mhm.
Okay, so
And,
Gemini.
and so you can argue, and this chart, you know, reflects that. Show this, the black line is the price of Bitcoin. And it makes sense, right? As the supply of the available supply of this goes down, but the demand still is constant or increases, obviously the price is going to go.
So to explain this really quickly, like the orange line going down, it's because it's not that those the Bitcoin's been retired. It's because people are keeping it as a store of value.
Right, they're taking it off the exchange
And putting it in a
into
private wallet.
private.
It's just like you taking your money and shoving it in your wallet and walking around with it and taking it out of the bank like a disintermediary, so to speak. So this is what this is showing is that, okay, same amount of float is out there, but the accessibility, if you will, to the, you know, which is definitely driving up the prices.
Mhm.
This is an important chart actually from our perspective because this continues to support the price of Bitcoin. If it were to reverse in the other direction and people were starting to take and intermediate the money back into the system, let's just say, then you would see the price likely going in another direction. So anyway.
Yeah, actually, one last point on the previous slide. Right now, the metric that I just saw was 5.8% of Bitcoin is held actually on public company balance sheets. So 5% of the total supply of Bitcoin is currently held by institutional players.
Yes. Mortgage of the world, which we
And,
now have.
and this is early still. When we look at, as you were explaining to me yesterday, when we look at regular stocks, usually it's something like 95, 90% or so of the flow or available shares are held by institutions.
Yeah, so many, like, you know, when you look at publicly traded stocks, companies, you know, institutional ownership in the bigger ones can be between 60 and 90%. So, I mean, you know, so if you reflect back,
the fact that Bitcoin went from 0% to now 5-6% in the matter of a year or so is pretty significant.
So I'm going to ask this question here. Do we want to see if anyone needs any clarification on what we went through so far? Or do you think we should keep going
Sort
forward?
of like a mid.
Just a midpoint, just to check to see if
Open it up a little.
anybody has any questions about what we showed? Or we open up a Pandora's box here?
I did have a question that came in that was talking about the ESG component, asking specifically how ESG ties into crypto. I know we pretty thoroughly covered the environmental part of that. Do you want to touch on the S and G side?
I'm going to let him do that, but before he does that, I'm going to say what I said to somebody yesterday. It's just like anything else out there that it has the propensity to be socially responsible and it has the propensity not to be. It comes down to the individual decision, and you can look at that with companies. The leaders can decide to be more socially responsible or not. So just so you know, it really comes down, in our mind, it always comes down to what's the project, what is it really all about? Because you can do cryptos, people can initiate cryptos that don't have that philosophy. So just let's be really clear about that.
Right.
Yeah.
Blockchains, distributed ledgers are a tool.
Yeah.
It's how you use
It's
them.
how you use it. It's all
Now-
about your own consciousness.
Right.
around this.
Arguably, that tool really lends itself to more transparency, better governance structures, more equal participation. It allows more access to, all you really need is an internet connection and a phone, and you can tap into these networks and start participating. You don't need to, go to a bank or open an account with some third party or anything like that. So from a social perspective, right, it really does provide much more transparency, much more participation. What the technology itself does in terms of certain asset classes and investments that normally wouldn't be accessible are now accessible to different people. So that's kind of really the social and governance pieces have to do with how the technology's native to what it enables, right? So transparency, immutability, you know that when your transaction takes place that there's a permanent record of that, and no bank can lose it, no money supplier can fiddle around with it or anything like that. So if you imagine where you could go with this, right? Entire voting systems that are tied to an individual person with complete accuracy could be created, so you could have much more fair, tamper-proof voting systems, record keeping from land records to title insurance on houses. I mean, anything, right? Becomes that much more reliable, secure, and transparent. So.
The other couple questions I had weren't necessarily to anything up to this point, so I'll bring them back up at the end.
All right.
Okay, perfect. Let's go forward.
All right, total locked value. This is a really interesting metric in the space because it shows, in our opinion, how much people trust the blockchain because they're willing to lock their cryptocurrencies that they paid for into certain smart contracts or lock them on certain blockchains where ultimately they get some form of interest from that, but they don't have access or the ability to pull them out until certain conditions are met.
Yeah, this is a pretty new thing that I would say evolved in the last year or increased in the last year.
Oh yeah, I mean, just from
nothing.
last May, I mean,
Yeah.
it was near zero in this, and
There are
now
certain-
60
right.
plus billion dollars, I think.
Yeah, there are certain there are certain cryptos that you can buy that you can, do this to and you can earn. I mean, some of them are at 6%. It's kind of I'm looking
Yeah.
while you talk. Go ahead.
Yep.
I'm gonna see what that is.
Yeah, all these different DeFi protocols have ways where you can stake your tokens or lock them into contracts to provide liquidity, and then as payment you get an interest rate back from that. But ultimately, those funds are locked up for a certain period of time. So the fact that people are willing to actually lock, I mean, not just people, it's over $60 billion is currently locked in different contracts
Yes.
on these things. So to us, that says, people are starting to really jump into this.
Yeah, and this is a big, Ethereum, if you lock it, it's at 6%. For me, because it's such a new asset class and I like to have liquidity because there's a part of me that's a control freak, which is what you want. That I don't want to lock anything because once you lock, you're locked in. And
You're
that's-
definitely taking a risk.
Yeah, you're taking too much. It's already risky enough as is, so we want to mitigate, not that, look at 6% is really, obviously very interesting. But overall, I still like to have the control and we'd like to have the
It's
control.
just fascinating.
And I
What's
just
being
think,
built
yeah,
in this space and what's being
Unbelievable.
played out and what people
Yeah.
are starting to innovate.
Mhm.
Next slide. So this just shows total Ethereum that is locked in the Ethereum 2.0 contract. And so I won't get too far into the weeds here, but Ethereum is moving from ETH1 to ETH2, changing its consensus mechanism from proof of work to proof of stake, which is insanely more environmentally friendly. It's more secure, it's faster. Right. So proof of work, you're relying on a distributed network of computers using specialized hardware to basically crack or to solve really hard math problems. And it's extremely energy intensive. But that ensures that everybody on that ledger has the same copy and that every different node or independent verifier agrees that it's the same. It's a very energy intensive process to do that. Proof of stake changes it so that you're no longer relying on mining in that sense. Instead, it's individuals who are staking or taking their Ethereum, staking it and saying, I'm validating that the information that I have is correct and that nobody's cheating on this and that it matches everybody else's. If you do try to cheat or match, you lose your stake or a piece of your stake. So it creates a negative incentive to cheat. So if that's the basics of what proof of work versus proof of stake is, right? So anybody can participate that instead of requiring specialized hardware that requires a lot of electricity, you just need to have a computer connected to the internet. So the electrical requirement is like 9% less than proof of work.
So Paul, how much is this? That's
Yeah, so this shows people who are taking their Ethereum because they believe in what's happening here and then putting it into the S2.0 contract with no guarantees, just hoping that, you know, the transition goes smoothly and that for being the first stakers that they get some initial rewards or percentage return based on that. Right now, 4 million Ether is locked in this contract, which I believe has a notional value of around what, $10 billion or something like that.
Yeah.
The current price around 2,700 times 4 million. So yeah, around there. Yeah, it's still small. I mean, considering the space, but you know, Ethereum as a whole, I'd argue, is still not well known.
Right now, Ethereum circulating supply is 150 million, so it's a small percentage, but interesting.
Yeah,
nonetheless.
right.
So,
So,
okay,
so
good,
and then you can
good to
see
know.
price correlates with that too.
Yep. Okay.
So one more investment case I wanted to touch on was this idea of a triple point asset, something that we've actually technologically wise have never had the ability to do as a species until now. So this is kind of really cool, where you can have a triple point asset. And what is that? It's something that meets the properties of capital assets, which are like equities or bonds or real estate. They're assets that are productive, produce an ongoing source of value, and generate value or cash flow. That's what a capital asset is. Then you're a consumable, right, or a transformable asset, meaning that you can use it for certain things or transform it to get more value or something else out of. Things like this could be gold or oil, or commodities as a whole, like wheat even, or energy, right? And how it can be transformed, but it has value and it's used for something to make something else. And then the store of value, where you believe that whatever you're buying will hold value and be worth something at some point down the road, like gold or art, right? What's amazing is that digital assets allow for a token or something like Ethereum or Bitcoin to have all three of these properties at once, where it is something you can invest in as a capital asset. You can transform it. Arguably, Ethereum and the Ethereum contract acts as a form of gas to power the contracts on top of it, and then a store of value.
And again, I want to just say again that you never put any money in this unless you know you're comfortable losing it, because this is all theory, right? We do believe this will go in this direction generally, but Wild West, right? Still extremely early. So while we believe that these things are true and can be true, it's not tested yet. And that's the big thing right now.
Right. And our stance too really is there's no guarantee that Bitcoin or something is going to come and replace the dollar as it currently exists. No, it's more it will coexist with it. So, you know, the way we look at cryptocurrencies is, if anything, central banks and governments will adopt the technology and then basically just move their currencies onto these types of systems because they're faster and more efficient. And it actually gives the government or a regulating agency much more transparency and line of sight into how that currency is used. So it's kind of a no-brainer that that's the direction that governments will go into with their currencies. And then Bitcoin and these things will offer an alternative, but I'm not so sure that they're going to replace government issued currency at this stage. We'll see, I guess. All right, next one.
And you know, let's say, I mean, India announced that they want to create the government wants to create their own cryptocurrency, right?
Yep.
And again, our viewpoint is it's not so much about the currency, it's about the platform that something like that would be running on. So, you know, again, it's something to be considered.
Right, there's lots of different things we're talking about here. There's lots of different pieces that you can get hung up on or focused on, whether it's the currency and the cryptocurrency and how that's kind of a misnomer for what the entire technology enables. We're not just talking about Bitcoin, but many of the theories, you know, Bitcoin is the one that started it, and that is arguably the largest. So, which brings me to this whole point on information asymmetry. right? Where there's a lot of different people participating in this space from all around the world who have non-equal access to information. And then they have vastly different understandings and levels of comprehension around that information. So it creates a really, really complex and disinformation or misinformation filled environment that is propagated by a media system or news networks that are all about the clicks. They don't really care about the content. They just want to drive eyes to the website. So if there's some news that comes out that at face value looks like, oh my God, this is like India is banning Bitcoin or something, then they're going to spread that, because that was one that recently came out. But when you actually look into it, no, they're not actually banning Bitcoin. They're preventing financial institutions from settling their funds in cryptocurrencies, which has nothing to do with banning Bitcoin. People can still use it. So FUD, or fear, uncertainty, and doubt, gets spread all over the place in this space. So there's a lot of misinformation around there about it. Same with FOMO, or the fear of missing out, where people get caught up in the hype, which I think we're seeing currently with Dogecoin, where the founder said it's a joke. It has a massively inflationary tokenomics, where in order for its current price to hold, so many millions of dollars need to be spent every day on it in order to keep its price.
We're not interested in anything like that.
Right. So
I mean, this is like, just like when the internet started, there were companies that were farce, and we aren't interested in any of these kinds of things at all. So.
Right. So it creates this disinformation filled environment. So it helps to have people, who know what they're looking for, and what it also creates opportunity, having these things.
Yeah. So I'm being told that we have several questions, and we have 10 minutes left. So just let's see, I think there's a slide on regulation in here somewhere. I do feel like, let's go forward and see risks.
There's risks and regulations, and I think we have questions. So maybe just a point or two on here.
We'll go through this really quickly then, because this doesn't come without a significant amount of risk, and we recognize that.
Right.
So
off the bat, every risk that applies to anything in financial markets also applies to this, right? There's just some additional risks on top of that are worth being aware of and really trying to understand. Some of those include operating risk, where the exchange is open 24/7, and it is new, right? But things can happen overnight or outside of regular business hours, and if that is a risk in and of itself.
And it's just a highly volatile group. I mean, that's, you can.
Volatility as a whole.
Volatility as a whole, it's crazy. And, also very important, it is unregulated at this point. Okay. So, we do believe the SEC is going to come around to this at some point, and put in some, and we would, we actually hope that there is some thoughtful, I'm going to use the word thoughtful regulation around this, to create more viability here for the average person. And of course, political risk is a huge one.
Right.
Yeah. Is there anything else you want to point out on this?
Just to touch back on regulatory risk, some of the people who are now in positions of power to make these decisions, so the new head of the SEC is a former CFTC head, but he's very familiar with digital assets and has a generally positive outlook on the innovation that the technology enables. So the best outcome is that these do get regulated, but in a way that allows for innovation to continue, that isn't too burdensome, which ultimately it looks like from many of the different podcasts I've listened to and speakers from the SEC who I've heard talk about it, they want that outcome too. So that's encouraging.
Okay.
But and really anybody who joins the Willow Crypto SMA and opens an account, we do send a risk acknowledgement form around. That is a pretty lengthy document, but it really just so you are informed. It goes into every single risk that we could think of. I mean, it's not exhaustive, but it's everything we could think of, and what the risk actually is and why it's risk. So that's available by request, if anyone.
Oh, we had one more slide. I was mistaken.
Paul,
Yeah.
you need a drink?
Yeah, well,
The drinking, you
well,
do all the
well,
talking.
thanks everybody for making it to this point. The original PowerPoint I created was like 3 times the size, so we
Yeah,
were able to
okay.
whittle it down some. Yeah.
All right.
All right,
So
let's get
I will recap again how best to submit questions for folks that haven't had the opportunity yet. There's a little dual chat icon with Q&A beside it. Should be at the bottom of your screen. We have some coming in already. So Paul, Alexander, do you want to start with the live questions, then go to the ones we had received beforehand, or what do you prefer?
Let's go with the live questions and then we'll get to this.
So we have a live question, somewhat multifaceted from KB. Paul, looks like an old friend of yours, Killian. She wanted to say hello. So a lot of logistics questions. When you're comparing the crypto fund here to an ETF, how does the expense ratio differ? What is the fee? How is it taxed? We'll start with those 3, and then she has 1 or 2 more to follow up.
Got it.
Right. So we'll start with options for investing in cryptocurrency, because that really dictates what the fees are going to be.
Mhm.
If you have a traditional brokerage account set up at a traditional custodian or brokerage house, and you want to then buy digital assets, you have to purchase things called ETNs, or exchange traded notes.
Yeah, they don't have ETFs
Mhm.
yet.
Currently-
In Canada, they do, but not
Yep.
Yeah.
And so you have to buy these exchange traded notes. Those are typically, what you're doing is you're buying a share in a trust, and that trust then buys the underlying assets and holds those digital assets
here.
for you. So you don't actually own the cryptocurrency in that way. You own a share in a trust. Out there now, there's a few different options for some exposure to digital asset, cryptocurrencies that you can get through these. I think there's a new one that came out that the fee was like 50 basis points or something, but it's just for Bitcoin. If you were to get a diversified basket, I believe Grayscale, who is a trust company or a company that has some of these exchange traded notes, has a top 10 asset or top 10 digital assets portfolio or trust that you can buy into, and they charge 2.5% for that. So the fees range in the traditional world of anywhere from 50% to 2.5%. And that's if you're doing it on your own, right? You'd have to factor in too, then if you were working with an advisor, if they had any fees that get put on top of that too. The other option is to do it yourself, right? Or have self-custody, where you open an account at a crypto exchange like a Coinbase or a Gemini or a Kraken. There's a few other US-based ones that there's Binance US that you could do. And then you're just subject to whatever their trading fees are. Usually they have different maker-taker fees. They usually range like 50 basis points. The issue with that is that you're trusting this third-party crypto exchange to hold your funds as number one. So you don't actually have custody at that point. They still do. They're holding on to it. And if the exchange gets hacked, you're pretty much out of luck. And then it's, all the responsibility lands on you to, make sure you don't forget your password to log in, and you know what you're investing in, and you stay on top of all, right?
Because we're not even getting away
Well,
from
this
this
is the-
question.
Right. Well, the third one is Willow's fee, right?
Yes.
So the third is how would you do this through someone like us who offers a separately managed account? And our fee, I'll just bypass all the other stuff, comes to about 2.35% overall, where we're managing a diversified basket of cryptocurrency on your behalf, and you actually have direct ownership of the digital assets. They're actually held in your name.
Thank you.
So.
I
Thanks for realizing.
No, that's okay. And then how are they taxed? Okay, because this is the big thing. Like, there was a point where they weren't being taxed, and they're catching up, which
Right.
is,
It's treated
definitely.
as property.
Yep.
So if you hold on to it for the long term, for over a year, it's basically treated as a
Capital gains.
long-term capital gains.
Mhm.
If you sell it within less than you buy and sell less than a year, it just
Income.
defaults to income, so it goes to whatever your marginal tax rate is.
All right, and then the last 2 pieces of this question. First, this is a straightforward one. Are there options to invest crypto through an IRA or 401k?
Yeah.
And then are there EFT equivalent products that diversify which crypto Which crypto one is invested? Oh, I think are there different EFT equivalents for diversified crypto based on varying levels of risk tolerance?
No.
No, so
No.
like I just
Yeah.
talked about, right,
No.
there's certain exchange traded notes you could buy, but they're usually not diversified. Grayscale has one, but it's 2.5% fee on
Yeah.
top of that.
And it's just the top 10.
Yeah, right, and
best
it's
crypto.
passively managed, and
Yeah.
I would actually argue that probably half of the top 10 are not viable in the long term.
And then there are certainly mechanisms.
IRAs and 401ks.
Yes.
So if you have discretion of your 401k investments, you could theoretically buy those exchange traded notes, but that would be on you with your 401k. With IRAs, we actually have the option to open an IRA through the Willow Crypto SMA and have the IRA in your name, and then you can directly own these digital assets that way. The flip there too would be if you had an IRA at somewhere else, you could also buy those exchange traded notes out there too to get exposure if that's what you were looking for.
And it goes for Roth accounts as well. We have
Yeah.
capabilities to work with.
Okay. What
All
else?
right. Any other typed questions?
Um,
Because I have a few that were emailed to us too.
let's go over to yours. Yeah, I had one additional that was emailed in, but let's, Paul, start with what you have.
Okay, one of the questions was if you already had another wallet or you had a crypto wallet, could you transfer from that wallet to us without selling or having to take a capital gains? The answer there is yes. Our solution, the Willow Crypto SMA, is custodied at Gemini. They're a crypto exchange, but they're also a New York registered trust company, and we can actually accept blockchain transfers. So if you have your digital assets on a wallet or held at Coinbase or some other digital asset exchange, yes, you can transfer them directly to us, and there's no taxable event that happens in that case. So, all right. So the next question, there was a question about electricity use, right? I think we addressed that one pretty
And
well.
what has been the performance since you created this new asset? So we didn't create a new asset. We created a new, we're offering management for this new asset.
Yeah.
So we don't have those numbers at this time. I mean,
Yeah, right. Performance is
it's so,
it's
I mean, depends upon the day. Yeah,
Mhm.
so it's so new, we can't answer that.
and then in our
question.
world, we're so highly regulated. If
That
we don't
wouldn't
have
answer
the
that
right
question.
information, we don't have all the
Yeah.
stuff we'd need to give you an answer. to that.
Yeah, everything has to be audited and
Mhm.
we're really aware of staying compliant.
And that's why, I don't know if I don't know if a comparison is the right word there, but you look at, different digital assets, annualized rates of return, and like we mentioned earlier, Bitcoin is 230%, which is absurd. But, all right, so we answered that one too. Someone asked a question about Authy versus Google Authenticator. And so this is an interesting question. There's different ways to protect yourself and your accounts if you're doing self-custody. Highly recommend you take one of these 2FA softwares and use them because it makes it that much more secure, especially if you have your funds on a place like Coinbase or an exchange. Between the two, is one better than the other? I'd say they're about equal in terms of security. I know with Authy you can set a PIN to even access the app, so that might be a better thing. But in terms of what they're able to do, I would say they're pretty equal. It just comes down to personal preference.
Mhm.
And then another question here of how does Mind Crypto get to an exchange? Okay, so yeah, that's a great question, right? So you have these miners, right? These huge facilities, or just an individual who's mining, right? They have to attach an address to that mining, right? To that address to that miner, right? And so after a certain amount of time, or when a block gets approved and transacted, get done, or if a miner solves the algorithm and then gets paid their block reward plus a share of the transaction fees, it ends up in their wallet. So then all they do is transfer it to an exchange and sell, or they have agreements with third parties who buy it from them directly. So it's really straightforward, where the blockchain itself knows knows everything that's mining. Whoever's rewarded gets that gets that reward in their private address there, and then they can send that to an exchange to sell it. And as a function of how they operate, most of the crypto exchanges out there basically sell a portion of everything they mine to fund their operations. Because electricity is not cheap. And the hardware itself is not cheap and has a limited lifeline, where after a few years it degrades and needs to be replaced. So.
The last question I have over here, I think, is a really good piggyback to the one you just spoke with, which is, you know, as us as investors, not miners, how are we able to participate in buying cryptocurrency? How does it become an investable asset for the general public?
Right. So you just go on the exchanges and you can buy it right from the exchange, or there's ways to, right. Yeah, you talk to us and then we can move your funds to the right place to go directly buy these kind of assets. And then also there is, used to be popular at the beginning. I don't think so much more, but there is a peer-to-peer function too, where you can find somebody with digital assets who wants to sell it to you, and you can do the exchange directly that way too.
Yes. Yeah, but we do offer management in this space now as
Right,
well.
right.
Yeah.
Yep. And so just one last
Leveraging.
plug
his expertise.
for the Willow Crypto SMA. We manage a basket of diversified cryptocurrencies on your behalf that is in the projects that we see making or that are going to have, you know, significant, we believe, significant impact in the space. And so we offer that to clients of ours, or, you know, we can have a conversation to see if it's appropriate or suitable for you if you're not currently a Willow client.
So we have all of our contact details on this page, our website, investwithwillow.com. We also have a website, willowcrypto.com. For any questions at all, any follow-ups, or if you want to learn more, our phone number and a general information email are on this page as well. So you could jot it down, take a screenshot of all of our contact information here, and we would love to hear from anybody who's interested.
Of the page, the number.
413-236-2980.
Okay.
All right. Well, thank you everybody
Thank you.
for joining us. There is a recap that will get sent around probably in a week or so if you want to rewatch or anything.
Yeah, we're gonna just, you know, edit this and then get this out to you.
And
if you're
right.
interested.
Again, feel free to reach out to us if you have any questions or if you think you might be interested in something.
There will be a quiz next time we get together and see how much you actually retained of this.
Good luck, everybody.
Thank you. Thanks, everyone.
Thanks for joining, everybody. Bye.